Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And obviously last week there was a lot of economic data released both in South Africa and in the United States. But I think the focus needs to be on recent interest rate decisions. The SARB and Reserve Bank met and decided to keep interest rates unchanged, even though our inflation outlook has improved quite considerably and the currency has been fairly strong. So it might be useful to unpack some of that thinking. And then equally, the Federal Reserve also kept their interest rates unchanged. That was widely expected. But on Friday, President Trump announced a new chairman for the Federal Reserve, and clearly that has impacted financial markets. So I think from my perspective, those are the two key events. As we go through that discussion, I'll try and touch on some of the more recent economic data, but I think understanding where monetary policy is in the US and South Africa might be useful at this stage. So let's start with the decision by the Reserve Bank to keep the repo rate unchanged at 6.75. You would say that was broadly in line with market expectations, although if you look at a breakdown of the forecasts, a significant number of economists had anticipated a cut of 25 basis points. Also, if you look at the voting, it wasn't a unanimous decision. 2 of the 6 MPC members argued in favor of a 25 basis points cut. So clearly the decision was fairly divided. And I can see why there would have been an expectation of an interest rate cut. If you look at recent inflation data, it's tended to surprise on the downside. If you look at the most recent petrol price adjustment, that's significantly lower. And then if you look at the exchange rate, it's been especially strong. So there are compelling reasons for the Reserve Bank to lower interest rates. So that raises the question, why did the Reserve Bank simply keep rates on hold? And I think the answer is they've just been very conservative. Clearly, although inflation has made progress and is beating expectations and is pretty close to the new inflation target, the Reserve Bank will feel that inflation expectations need to be lowered further, and that the best way to get those expectations down is to have a policy approach that emphasizes their determination to keep inflation under control at around 3%. And so the Reserve Bank, I guess, would argue that they need more time to get inflation expectations lower, and that their forecasts are assuming that they will be successful in that outcome, but more work needs to be done. There are a couple of inflation risks that the Reserve Bank flagged. Nothing particularly serious, I would suggest. The one risk is obviously food prices, in particular meat prices, which are still struggling with the foot and mouth disease. So at some point that could become problematic again. And then the Reserve Bank has flagged the potential further increase in energy prices, particularly the NERSA calculation of how much prices had to go up, which they subsequently revised. So there are a couple of risks, but I would say that on the whole, inflation remarkably stable in South Africa, and it looks as if it can achieve an outcome that is very close to the inflation target. So that would suggest that we're not yet at the bottom of the interest rate cycle. There's still the prospect of a further cut this year. My view would be they could possibly cut in March. Then you could argue for interest rates to go on hold, and then when the Reserve Bank feels more comfortable that sustained progress has been made towards achieving the new inflation target, then there are additional interest rate cuts they could put in place. And if they do that, then obviously we reap the benefit of the lower inflation rate, and that's ultimately the objective. So I don't think the fact that they haven't cut in the short term should act as a discouragement. I think that if we are able to clearly get a 3% outcome on a sustained basis, then I've got to believe that the Reserve Bank will lower the real interest rate, and especially if the economy is able to create additional capacity and you're not simply growing the economy through consumption, but growing the economy through capacity building, infrastructure development, then I think the argument becomes even greater for further interest rate cuts. So I remain optimistic that we will get there, we will cut interest rates further, but clearly a conservative approach by the Reserve Bank, which is going to keep rates fairly high in the short term, keep the real rate fairly elevated in the short term, but hopefully deliver a longer term benefit for South Africa. The second topic is a discussion on the Federal Reserve's decision to keep interest rates unchanged. I think that was widely expected, so no shock in that decision. I listened to the press conference that followed the interest rate decision, and I think Chairman Powell tried his best to say as little as possible. He provided no real forward guidance for the market to focus on, and he certainly wasn't going to be drawn into any debate around politics and the influence of the Trump administration on the Federal Reserve. Subsequent to that, we know that the President has nominated Kevin Warsh to replace Powell as the next chairman of the Federal Reserve. That'll take place in May of this year, and I think you end up with a conclusion that says the Federal Reserve is probably comfortable with inflation, with interest rates remaining on hold all the way through to a change in the chairman. There was nothing in the statement or the press conference that suggested an unease with where interest rates are. They emphasized that the US economy is doing a bit better, that inflation is elevated, and that clearly more work needs to be done in order to get the US inflation rate down closer to the inflation target of 2%. So we are assuming interest rates on hold for a couple of months, and then we've got to assess what Kevin Warsh will do in terms of monetary policy. From my perspective, he's a credible appointment. He's been at the Federal Reserve as a governor many years ago during the global financial market crisis, but he understands the system. He understands the importance of the independence of the central bank. He understands the importance of the inflation target. I don't think you're going to get a radical change in monetary policy, and I also think it's a bit misleading to look back to his term in the Federal Reserve and draw hard conclusions based on that, simply because at the time, the global financial market crisis policy was unusual, and so it was designed to meet those specific circumstances. Yes, more recently, Kevin Warsh has argued in favor of lowering interest rates, but to be fair, he was making those arguments before the most recent cuts in interest rates, and it's a little bit unclear about what his approach would be right now. So I think we're going to have to wait for his actual appointment and see how he starts to shape the Federal Reserve. And I think it's going to be an evolution of that policy. I don't think you're going to get a radical change. There are areas where I think you'll get more attention. The balance sheet management is going to be a key area, and obviously whether or not he wants to back away from the high profile that the Federal Reserve currently has in terms of the number of press conferences and the dot plot, etc. So some of those things may change, but I'm not convinced that there's going to be a radical change. I think it's going to be an evolution over a number of months, couple of years, in order to put the Federal Reserve in a different position from where it is now. And I think in the end, I think it's going to be long-term favorable for the US economy and for financial markets. So I'm not expecting to see a radical change. So we end up with a situation where I think people are coming around to the idea that you're not going to get successive cuts in interest rates during the course of this year, certainly not in the first half. It doesn't mean that the US is at the bottom of the interest rate cycle. I think there's an argument for them to cut interest rates a little further. We still have two interest rate cuts built into our forecast for the second half of the year. I think that's entirely achievable. But I think beyond that, the Federal Reserve will probably feel that they're at or close to the appropriate level, and that their focus will then be on trying to maintain stability in terms of monetary policy and trying to ensure that both inflation and economic growth are reasonably solid and within the parameters of their overall long-term monetary policy objectives. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.